Welcome back to the second half of the Future Show. Less than 60 minutes away from the cash open for stocks on Wall Street. We've got Alan Nuckman joining us, Chief Market Strategist at BullseyeOption.com. Alan, never thought I'd be saying this, but there's a lot of attention directed to these weekly jobless claims. Talk to us about the number and market reaction to it here.
I know we all have a job to do, but my job is just to monitor the market and trade what I see. And what we saw, and you were right on with your analysis this morning, the biggest issue, and I've been talking about for weeks, I think months.
Wait, slow down. Can you say that again, please? I want to get that on tape. You saying that what'd you say one more time?
You were spot on this morning with your analysis.
Hey, all right.
It's all about the dollar. We had a 100 handle print yesterday, 100. So we're ready to see if we can break that bottom. And I told you it was a paradigm shift if we were going to get the euro above the 110, if we were going to get that dollar to go below the 100. So now it's going to be very much bullish for so many stocks and so many commodities that you're seeing gold make new highs. But we haven't seen that follow through in energy just yet. So I think it's kind of like the same thing we had in gold about 2 years ago, where it had every reason to go up and it didn't. And now we're seeing that thing, saying the same thing in energy, where it's got every reason to go up, but it's not just yet.
I like that, Alan. You're probably very familiar with a market that waits for the impatient bulls before it breaks out, right?
Right.
Real quick, let's talk a little bit about this. At 232,000, basically in line with expectations. Consensus was for 234. That's not going to change things.
No, it's not going to change anything at all. And, you get in the minutia. I know that. That's what people do. But again, it's just about how the markets react. And
you're looking, the dollar you see at the epicenter of these moves right now.
Right. The dollar's been for the last 5 years, been between 110 and 90. So this 100 is in a crucial pivot point. If we move below that 100, then we got a lot of downside momentum that continues to move. So we've got rates down, VIX down, dollar down, everything else is up. And the comeback in stocks, again, has been epic. And if you look at the S&P, that projects a V recovery, projects 6,300, which is 15% higher, and a NASDAQ recovery. We're 4 or 5% off the highs in the NASDAQ, but it's already up 15% off the lows in 2 weeks. But a NASDAQ recovery targets 24,000, which is 20% above.
Yeah. Okay, I want to talk commodities, which we can get to in just a second, but one more quick thought on the dollar. What's going to be the catalyst to get us lower here at this point? The euro currency has been strong. We were talking about the British pound in the last segment, some of the strength we've seen there. Is it going to be Powell tomorrow? Is it jobs data to come in the beginning of September, the FOMC meeting, some of the other central banks that we'll be hearing from in the very near future?
Yes.
All of the above.
Any or all, but to me, it doesn't matter. I don't care. I don't get paid by predicting which event is going to cause the markets to move.
Just by analyzing price.
Right, and I don't get paid by predicting, are we getting a 25 or a 50? Looking at the market, there's a 30% chance of a 50 cut. But obviously, if you look out to the December or January, we're going to be a percentage point lower than we are now. So that's what's important, is the trend. It's happening. That's what's important. This is a parlor game. There is no money made by being correct on the 25 or 50. The money is made by being correct on how the market's going to react. That's it. That's it. Simple. I've been doing this for more than 30 years. That is it. It's fun. It's exciting to talk about, but it's exhausting the way you guys dig into it sometimes.
Okay, let's dig into it a little bit more. And exhaust you a little bit more, but no, I'm kidding. But let's talk a little bit about what's been going on, because that weaker dollar has now started to spark a bit of a bid. We've seen, you mentioned gold, right? Definitely correlated. Inverse correlation has been very closely watched and identified recently. But I've been watching silver also inching its way back up to the $30 level. These are products that you've been telling us to watch for, that we're going to start to rally back, and they are.
Right. So gold was first off. I want to mention how to trade, because that's equally as important as what to trade. So when we had the profit-taking pullback on that Monday, it was, I guess, August 5th, only 2 weeks ago, 2.5 weeks ago. So it was a 2% move, but 2% in the Dow is, 1,000 points, because we're at such lofty levels. The S&P, 2% in the S&P was 100 and some points. Anyways, when we saw that profit-taking pullback, the volatility had spiked, and I'm an options trader, so it's really hard if you bought anything at that point to be successful because the volatility was so pumped up. When the volatility came out of those positions as an options trader, even if you were right on direction, you're probably at like break even because of that, situation. So gold was the one market where the volatility did not spike. And gold had a little bit of profit taking and unwinding because, as you know, all these markets are interrelated, and people that had stock positions obviously needed money, so they may have had to get out of their gold position. So gold was down temporarily, but the dollar was down, and that was the recognition of a textbook setup to get back into gold, and gold had a rally from that standpoint. Now, silver, not so much. Silver disappoints. Silver did get back above the 29 level, which was a crucial support, and it dipped below that. But it tested. Now, I guess you could look at reject it. I love the risk reward in silver if you can, if you can stomach the moves, because we all know how silver moves as far as volatility. That's why I'm an options trader.
Alan, in terms of that lack of volatility in gold, right, lack of participation to the downside relative to the broader market in gold, is that what you sometimes talk about, how you look for strength into weakness?
Well, I was looking at gold from a risk-reward standpoint, and technically we've been trading in a range, and we were at the lower end of the range, but it was all about the dollar. The big news of the profit-taking was the dollar getting slammed in that paradigm shift where the euro and everything else reversed. Those were crowded trades, and it needed that shakeout. And that was, again, the beginning of this next bullish catalyst is the dollar. It's that simple. And that's really what I was looking for there. But again, silver hasn't participated yet. And the most disappointing, I think we talked about last week, has been copper. Copper's now back above 4. What I'm focusing on now is, we talked about natural gas a couple weeks ago. Natural gas made a nice little bottom base, best risk reward that we had, in an everything bull market, where it was down at those lows, made new lows, but not new highs and implied volatility. That is usually a sign of a sentiment shift. And now we've seen a little bottom base. But we're starting to see the same thing in unleaded gas. Now, unleaded gas is obviously related to crude oil, but unleaded gas has been between 2 and 3 for a year and a half. So down here at the 2 level, it's got good risk reward. And we all know that gasoline prices don't have sharp drops. They have sharp rallies, but they typically don't have sharp drops for the consumer.
Okay, so you're hating on copper, it sounds like, but much like silver, copper, and maybe even one could argue gas now, you feel like there's some upside potential here, right? I mean, especially in these laggards, there's some catching up to do.
Yeah, it's all about risk reward. And again, we talked about how they're set up and how the dollar is this catalyst, but there's a delayed reaction. People have this idea that the markets sometimes react, directly, which they do. But, we had the Ukraine war. We have the, situation in the Middle East that you would think would be supportive of the energy complex. And they really weren't. And it's made people, confused, because the common sense, and, I try not to think, and common sense is you would think that that would be a positive for the energy complex, but it wasn't. It's how the markets react. And so now there's been a long, drawn out, should have been bullish situation that I think once people give up on it, that's when you have to be looking at it. But again, it's about price and how the markets react down at these bottoms. And for crude oil, the 75 pivot has been interesting between 85 and 65 for more than a year. 75 has been a pivot on a weekly basis, and every time it looks like it's going to pop, it doesn't so far.
Okay, so I like that kind of mindset, right? Definitely in terms of gold. Those that were not patient around that 2100 level didn't get to participate, right? Knocked on that door multiple times and eventually did break out, but only after shaking out some of those longs. And in terms of how the market reacts, kind of tying it all together before we let you get out of here, Alan, I've been arguing for a while. Crude at this area, 70, 80, and below, kind of in that range that we've been in over the last year, definitely. I mean, that is supportive of what we've seen. The market's been reactive in a very positive fashion. The fact that we didn't see a major spike up to 90, 95, for example, retesting those highs that we saw last year, tied to the, geopolitical tensions and such, right? So again, how the market reacts, stocks have reacted very favorably to crude being in this range.
Yes and no. I'm also going to say that stocks react favorably to crude being higher. Crude right now is half. Let's just say this again. Half right now of its all-time highs. So that means it's down 50%. So it's a bargain. It's cheap. Whereas the rest of the market's high. The PE in the energy sector is 8. So there's a lot of value here. And if crude oil does get more bullish and breaks out, that's supportive of all those stocks in that sector, and therefore another catalyst for the stock market. You remember a time, when we were younger, and it's not that long ago, it's only been, 10 years, that crude was the major driver of the S&P as far as, the complex that
I remember
had the most capitalization. So if you look at Exxon, it looks like it's trying to break out of its top. There's a lot of positives here that I think people are overlooking, and I'm a believer that when crude prices go up, that's a positive measure of the economy and demand. And even if we go up to 100, that's not catastrophic for the market. If you adjust the 2008 price for inflation, it would have to get up to $197. So, we are nowhere near. I know it's in a pressure button, and I know it bothers people, but crude prices are not that big of a negative. And then I'll throw it out there again. From 2011 to 2014, crude was above 100, and the market rallied 33%.
Alan, you are a believer, and Kevin Hinks isn't in the studio or in the newsroom right now, so I can say that you are the most half-glass full guy that I know in markets and analysts that I've worked with. Alan, appreciate you joining us. Ladies and gentlemen, this is Alan Nuckman, Chief Market Strategist.
Thank you.
Thanks to you, Alan, Chief Market Strategist at BullseyeOption.com.